All right, so you're stuck in your 2.5, your 3, maybe 3.5% rate, and you're trying to figure out, how do I access a little bit of equity? Maybe you took out a little bit too much in credit card payments. Maybe you have some other things you want to work on. Maybe you're financing a home project. You guys are redoing your kitchen or your bathroom or something like that. How do you tap into your home equity? Now, obviously there's refinances, and I talked about that in one of my last videos, and actually had a comment say, hey, can you do the same thing with HELOC? So that's why I'm here doing the same thing with a HELOC and a HELOAN. We're going to explain the difference and when you use either one, what the benefit of it is. So looking at a HELOC versus HELOAN, jumping right into it. Basically, what is a HELOC and how does it work? It's a home equity line of credit, HELOC, home equity line of credit. That's what it stands for. Basically, it's like having a credit card that instead of having a max limit on the credit card, it's actually attached to the equity in your home. Now, when you're using these, you get approved for a certain limit, let's say up to 90% of the home's value in that HELOC, and then you only borrow what you need as you need it. So you basically, they'll give you a checkbook and you write a check for how much you need. So let's say the HELOC amount was worth $100,000, but you only need $25,000 of it. You're funding a kitchen or you're doing something else with it. You actually get to write yourself a check for $25,000 and it pulls from the home equity in order to use it. So these are adjustable rate. Their HELOCs are almost always going to be adjustable rate mortgages. They work really well for home improvements, emergency fund, paying off any other high interest debts, such as credit cards or car payments, things like that. Usually not car payments, but there we are. Or ongoing expenses if you don't need some sort of lump sum of money. Again, they are interest only. So usually these come in either 3, 5, 7, or 10-year draw periods. So basically you have 3 years, 5 years, 10 years, or 7 years to pull as much as you can pay off this. I do know of people that have used these with businesses. They'll take a draw on the house for the business for a couple months and then put it back in. And then once the business is back the money, pay it off and then use it again for another thing that's happening. Just like a credit card, you pay it off, you get to reuse the money as long as you're within that initial draw period. So that 3, 5, 7, or 10 years. So make sure if you're doing a HELOC, you understand how long your draw period is. With that being said, these are adjustable rate mortgages. So usually how they do it is the first 10 years or so, you're paying interest only. So if you have a $100,000 HELOC open and you have a draw of about $50,000. So again, think about the $100,000 is your credit limit. That's if you had a credit card with a $100,000 limit, and your draw is what you spent on the credit card, right? So you have a $100,000 limit and you've drawn $50,000. You're not paying back any principal for the first 10 years. You're paying interest only. So you're paying a very low, you're just basically paying that 8, 9% interest on the $50,000 you have drawn. Monthly payments keep pretty low because of that. Obviously, as I mentioned, you can choose to pay off the actual principal amount as well. So you get that money back. You are absolutely able to do that. But the way HELOCs work is oftentimes people will use them for some sort of home improvement after it's done, do something like refinance the house or plan to just pay it off over time. You can end that draw period early. Instead of that 10 years on the line or 3 years on the line, you can end it early so you do start paying principal sooner rather than later. Usually with these being said, oftentimes you'll see like a 10-6 is what they call it. So it's 10-year draw, and then every 6 months after that, the loan is adjustable. So it is adjustable rate. You do have things called a cap as well as your margin, and that's going to depend on, there will be a cap for the max that the loan can actually, the interest will be able to go up to. So let's say you take it out at 9%, maybe the cap is 12%. So you'll never see it above the 12%, but depending on where the market sits, it will go up and down. Same with the margin. How much is it going to change? So repayment period is going to depend on the loan of itself. Every HELOC has a different draw period, a different requirement. So again, 3, 5, 7, 10 on the draw period. And then it's going to start paying it off after that. Usually these are almost always 20-year loans. You have the draw for the initial amount. And then once the draw ends, that's when it locks in. And then your payment becomes an actual payment with principal and interest. Again, there's so many different HELOCs out there. Every broker has a slightly different version of this. So make sure if you decide to go this route, you understand what's your draw period, when does it lock in to pay principal and interest, and is there a minimum draw required? I know most HELOCs in California require you draw a minimum of $50,000 up front as your first draw. Not all of them, but a lot of them. Now, with that being said, when are these beneficial? First off, they're beneficial if you don't need all the money at once. You know, these $100,000 HELOCs, $80,000 HELOCs, if you only need $50,000, you can technically draw out $50,000 and then pay it off right after and then reuse this again. So it just depends. When do you need the money? Do you want the flexibility and oftentimes the lower monthly payment? And because the interest only payments, you're not paying principal as well. Even with the higher interest rate than say a HELOAN or a refi, usually you have a lower monthly payment. So it just depends on the needs you have. Now, if you're planning on paying off quickly and reusing it, again, great thing. I've had clients in the past, basically they have a $100,000 HELOC, $50,000 is the minimum initial draw. They have to take out that $50,000 up front, but they may not know exactly what they're using the HELOC for yet. So they pull out the $50,000 up front. Once the loan closes, after a week, they actually pay that $50,000 they pulled out back into the loan. So now they're paying basically nothing out of pocket. There's a small monthly fee associated with having this open. And then basically they can now redraw whatever amount they want at any given time. And they're not really paying any interest on anything unless they have a draw pulled out and available. Now, the benefit of these, you're not paying off the total amount. You're only paying off the draw. So you're only paying off what you've used, which is really great. Now, the second part of this is what the heck is a HELOAN? Now, a HELOAN is very similar, home equity loan, HELOAN. So HE, home equity, and then loan. Obviously, that's just spelled out. Now, this is going to be a lump sum that's secured by your home equity. This is a fixed rate, fixed term mortgage almost always. So these are going to be very similar to an actual refinance, but it's going to be in a second lien position. So instead of being first mortgage, you're not touching your 2.5 to 3.5%. You get a separate loan for the fixed rate for however long. So these do go typically 5 or 20 years. We actually do have a 30-year option as well. The interest is almost always fixed on the HELOANs, and your principal and interest payments begin immediately. You're not doing two separate things. You don't have interest only like the HELOAN. So the monthly payment is a bit higher, but because it's fixed and non-adjustable, oftentimes the rate is lower, especially if you're at that 15 or 20-year fixed term. What we're seeing is rates anywhere from 1 to 1.5, sometimes even 2% lower than the HELOCs because it's a fixed rate. So it's less of a risk to the bank. You're not going to be taking out constantly. You get a one lump sum of money. Now, a HELOAN is beneficial when you know exactly how much you need. You want stable monthly payments that will not change, that are not going to be adjustable, and the rate's not going to be adjustable, or you're using it for a single purpose. A lot of times they'll use these for something like a full remodel, debt consolidation, or funding a one-time larger expense. Now, you're also not concerned about interest rates rising because these are fixed rate mortgages. So again, with these loans, it's going to depend on the broker or the lender that you use. Everybody's going to have a slightly different service. I know for some of the loans available, we allow you to go up to a higher loan to value using a HELOC. Then we do a HELOAN. Again, the second mortgage, just the way they do the cash with the equity standpoint, we can go up to technically a 90% with a HELOC. So if you own a home that's worth $500,000 and you owe $300,000, 90% of $500,000 is going to be $450,000. You could technically take out a HELOC for $150,000 from the $300 initial amount to the $450,000 amount is $150,000. Whereas oftentimes the HELOANs are going to be an 80 to 85% max. So instead of that $450,000 being the max value of that same $500,000 purchase price, you could take it out to $400,000 or maybe $425,000. So you might be able to get more with a HELOC if that's what you're looking for is the largest amount of money. But as always, it just depends on your usage and your needs. Now I'm throwing up a little chart here. Going to be available down below too of which option should you choose. And it's just going to take you through, hey, which one makes more sense for me? And you can check yes and no on these questions to see what's going to happen. If you're looking at doing a HELOC or a HELOAN or even just a cash out refi to pay off credit card debt or any other high interest debt, you can do what's called a blended rate. So it'll take those two numbers and say, hey, if you're paying 25% on your credit cards and you owe $60,000 and you have your home payment at a 6% or a 3%, would it make sense to do a HELOC where you're paying off that higher interest credit card debt, or would it make actually more sense to do a cash out refi? And overall, it'll actually lower your monthly payment. So you can do the blended rate calculators to see, does it make more sense for me to keep my 2.5, 3% and then take out a 9, 10% HELOC? Or would it make sense for me to actually refinance everything into a single payment of a cash out refinance and then have a rate of maybe 5 to 6%? So those blended rate calculators are super helpful when you're trying to figure out what you want to do if you're pulling out equity. And then you just want to understand, again, what's going on with your money, because you don't want to go take your equity and just spend it willy-nilly. You want to be able to really make this money and save. So if you have projects coming up, if you're working on high interest debt, this could be a great option for you to use an asset that you have, which is a house, to pay off some of those high interest credit cards and really realize that you're paying, when you take out a mortgage for a home, you're paying for an appreciating asset, something that's going to go up in value versus all your credit cards, your cars, those are all depreciating assets, unless you're talking like a 1960 Porsche. So with that being said, if you have questions, reach out. I'd love to answer them for you, talk with you, or go ahead and schedule a one-on-one consult. But if you need to pull some equity out of your house and want to pay off some of your debt, this could be a great way to do it. Run your numbers and see if it's going to make sense before you pull the trigger.